Hello, everyone. Good evening. I'd like to welcome you to our webinar entitled Types of Business Structures Part 2, because Part 1 was very exciting. We needed a Part 2. Hosted by the City of Los Angeles's Department of Cannabis Regulation. My name is Ernesto Morales with North Star Alliances, and I will be the moderator for tonight's webinar. Before we get started, let's take a moment to review some housekeeping rules. Please note that this webinar is being recorded and can be viewed after the editing process on DCR's LMS system by social equity verified individuals. You will be muted with cameras off for the duration of the webinar. This means that your camera and audio functions will not be available to you during this session. However, you'll be able to see and hear all the panelists. There is an open chat box where you can interact with one another for networking or comment on the information being provided. Please use caution when sharing personal information in a public forum and keep your questions focused on tonight's topic. Please ask questions. Ask questions about tonight's subject matter in the Q&A box. We are gathering and responding to your questions throughout the presentation, and we'll have a Q&A session where you'll also get responses in the last 15 minutes of tonight's webinar. You are encouraged to utilize the Q&A box at the bottom pane of your Zoom screen. If you use the Q&A box for questions, everyone will be able to see the questions when they are answered. And finally, please note that the content being presented tonight was not created by the Department of Cannabis Regulation or the City of Los Angeles and is for informational purposes only. The information is subject to change and does not replace or supersede the Los Angeles Municipal Code nor constitute legal advice. If you have specific questions outside of tonight's topic, please call 213-978-0738 during business hours, which are Monday through Thursday from 10 a.m. to 4 p.m. to speak to a DCR representative. Now, I'm very pleased to introduce this evening's subject matter expert, Zachary A. Knox. He's the managing partner at the Knox and Ross Law Group and leads the firm's cannabis practice group. Mr. Knox is considered an expert in this field and has spent over a decade advising and representing cannabis companies and entrepreneurs across California. In 2016, he was appointed to serve on the City of Oakland's Cannabis Regulatory Commission and continued to serve in that role through 2019, including serving as the commission's vice chair. Mr. Knox and his firm have been the contract legal service providers for the City of Oakland's Cannabis Equity Program since its inception in 2017. The firm has since been contracted to serve equity programs in the cities of Fresno and San Francisco, as well as outside of the state of California. Without further ado, I'd like to ask Zachary to join me on screen. Hi, Zachary, welcome. We're very excited for you to start your presentation tonight. Thank you.
I'm very happy to be here, and Ernesto, thank you so much for the warm introduction. And I thank the DCR for bringing me back again. We have a very important conversation that we want to get through tonight. As Ernesto said, that this is going to be Business Entities Part 2. I'm going to go ahead and get my presentation loaded up here. And so what we're going to talk about here tonight are different ways in which you can organize your for-profit business. And we will examine a number of those different ways that we could organize your business. And we'll talk about the strengths and weaknesses of each of those business forms. And I think as we go through that, you will begin to get an understanding of why there are only two types of business entities that we recommend for this particular industry. So with that, let's jump into it. So this is what we'll be covering tonight. We're going to talk about sole proprietorships. We're going to talk about partnerships, both general and limited. We'll talk a little bit about corporations, both S and C corporations, if you've heard of those. We will talk about limited liability companies, and we will conclude the presentation with the recommendations that we typically make to our own clients getting into the cannabis business. So sole proprietorships, as you can see on the slide, this is just you, right? This is you putting yourself out there for business. This is you hanging your hat and going out and doing the work on your own. Some of the features of a sole proprietorship is as you can see, they do not afford you as the owner any sort of limited liability protection. We'll come back around to that throughout this presentation. It is a very important concept that we'll need to discuss. And what it essentially means is that you as the owner are personally liable for all of the debts, as well as any claims that might be brought against your business. So if your business gets sued, or if there's a creditor that you can't afford to pay, and the business doesn't have enough money to pay that bill, then you personally can be held responsible for that. And for that reason alone, we do not recommend sole proprietorships under any circumstance for this industry. Some other reasons why sole proprietorships won't work: equity investors just won't do it. All of the businesses in the cannabis industry are capital intensive. You will likely need to raise funds to get them off the ground, and people invest in businesses. They may invest in a business because of you, if they believe in you, but they cannot invest in you. You cannot sell equity in yourself. There's no equity available for them to purchase. So there's another reason why sole proprietorships just do not work well for this industry. All right. Well, what about if there's more than one of you? And when there's more than one owner in a business, those owners become what we call a partnership, a true partnership, in this case, a general partnership. So if a sole proprietorship was just you operating a business, you and your buddy operating the same business becomes a general partnership. In a general partnership, all partners are on equal footing, and they generally have equal participation in management decisions. They have equal participation in the proceeds of the business. So if there are two partners, you can imagine that's 50-50. If there are four partners, the business is split four ways equally. And that's what a general partnership is. So maybe you can't go out and raise the capital from investors, but you could partner with other people. So this is the next progression past a sole proprietorship. And unfortunately, it also suffers from many of the same weaknesses that a sole proprietorship suffers from. General partnerships, again, do not afford their owners limited liability protection. So again, what that means is that each owner is personally liable for the debts of the business, as well as any claims brought by the business. So it has the same weakness that we would associate with sole proprietorships. And with that came the idea of, if a general partnership is not really workable, what about a limited partnership? And to understand the difference between a general partnership and a limited partnership, it basically developed when certain partners were not going to be involved in the actual management and operation of the partnership. And because they were not involved in making those management decisions. They're looking for a little bit of shielding from decisions that their operating partner, their general partner, made. And so, as you can see here on this slide, in a limited partnership, there is always at least one general partner. There is somebody who needs to be responsible for the business. And again, personally responsible in this case. And so you have one general partner and you have at least one limited partner, but you could, as you see in the diagram here, have multiple limited partners in a limited partnership. One of the unique features about a limited partnership is that all the limited partners enjoy limited liability protection. They are not going to be personally liable for the debts of the business or for claims brought against the business. They are only liable to the extent that they have put any money into the business themselves. So if you have a limited partner who put in $10,000, let's say, and there's a claim brought against the business, and the business is unable to pay that claim, there's no scenario where the limited partner is going to have to come back and pay some additional money to answer that claim. Whatever they've invested in the business to that date, that is the full extent exposure of their liability. And that's a little bit different from their one general partner who still has full personal liability for any claims brought against the business. I think one of the other unique features that we should discuss with regard to limited partnerships is that the distributions of proceeds in the limited partnership is not necessarily apportioned equally amongst the partners the way it is with a general partnership. As you saw on the other slide, there's two partners, they split it 50-50. If there's four partners, they're going to split it 25% each. It doesn't have to be that way in a limited partnership. And oftentimes the rights to participate in those distributions in a limited partnership is something that gets negotiated between the general partner and the limited partners at the time the limited partners come in. So once again, limited partnerships, unlike sole proprietorships and unlike general partnerships, must also register with the Secretary of State. And as we go on, you will see that all of the entities from here on out will require you to register with the Secretary of State. If I hadn't mentioned this, the limited partnership as a structure gained traction because investors could come in. They could come in as limited partners. They would be shielded from personal liability. But this structure has nevertheless fallen out of favor, in part because the general partners are still personally liable. So yes, there's a structure where they can bring investors in and those investors can be protected, but it's not very appetizing if the general partners can still be held liable for all claims and debts against the business. And while the general partners have that level of exposure, even with the limited partners, even with the investors, there is some dissatisfaction with this model because the general partners have all of the decision-making power. So it wasn't a perfect balance of the investor's interest in terms of limited liability and being able to have some level of control over how their investment gets used. And it didn't really meet the general partner's needs. Although it allows them to bring in investment, it didn't protect the general partners themselves. And so this led to the development of corporations. And as you can see here, many investors will favor a corporate or an LLC structure over limited partnerships, in part because they have greater oversight and greater power over management of the business, as we discussed. All right. So I think it's appropriate for us to take a step back here and, talk about limited liability protection. Right. So each of the structures that we have discussed so far, sole proprietorships, general partnerships, limited partnerships, they each suffer from a lack of limited liability protection in some capacity. So let's take a brief second here and talk about the importance of that protection. Again, whether you're a proprietor, a general partner in a general partnership, or a general partner in a limited partnership, you do not benefit from limited liability protection. And without that protection, you as owners remain personally liable, not only for the debts of the business, but also claims brought against the business. So if you have another job somewhere else, if you have property that you own, if you have assets, all of these things could be reachable by somebody who is claiming a debt against the business or bringing any other sort of legal claim against the business. And in those scenarios, if the business can't afford to pay its bills, then the creditors can come after those personal assets. They can try to place a lien on your home if you have one. They can try to place a levy against your bank account, potentially. They can sue you personally to satisfy those obligations, whether it's a debt obligation or whether it's a civil judgment against the business. And these are things that we want to be conscientious of, because you will be bringing in labor, you will be bringing in employees, and you might potentially be found to be tax deficient in the calculation and payment of your taxes. We'll get back to that one later. That will be an important point. But as you can imagine, without some sort of limited liability protection, if the business were to fail, or for whatever reason can't meet its financial obligations, you can be held personally liable. I want to make sure that I'm reinforcing that point, because this is a critical point in why we recommend certain structures, particularly in this industry. Right? As you can imagine, many owners would prefer a business structure that affords them limited liability protection. And owners with, personal assets to shield are going to need that protection. And therefore, their liability is limited, as I mentioned earlier, to the money that they've already invested in the business. And that's where we get the name or the phrase limited liability. So if you can imagine, there has to be some way of addressing this limited liability issue, but at the same time, preserving a business's ability to bring in investors and raise capital. And that was the advent of corporations. Right? So what you see on this slide here is a general structure for how corporations work from a structuring perspective. The eyes that you see above the triangle represent for investors. They are the owners of a corporation, and they hold shares of stock. And those shares of stock are really just an expression or a tool that is meant to represent each owner's ownership interest in a business, right? So from a hierarchy perspective, the investors as the owners sit at the top of the pyramid. The corporation is ran on behalf of the owners by a board of directors. The board of directors answers to the owners, they answer to the investors, and they owe those investors a fiduciary duty to run the corporation the right way. Now, oftentimes a board of directors will defer part of its authority, typically around day-to-day operations, to the officers of the business, which is why you see officers falling just underneath the board of directors in this sort of pyramid diagram here. So oftentimes in small businesses, as many of you will start out, you will be wearing more than one hat, right? You're an owner, and while an owner does not necessarily have to run the business, as I described, you may find yourself in a position where you are running the business, right? So as I describe this hierarchy, let's not get too lost into it, because you may find, particularly early on, that you're wearing a number of these different hats. And that's okay. We just want to make sure that we understand what our role is under these different areas, right? So the shareholder, the stockholders do not necessarily run the business. If you can think of any Fortune 500 company, let's take Apple, for example. You can go buy a share of Apple stock right now in one share, just one share, and you become an owner. Trust me, Tim Cook and Apple is not going to come and ask you what you think about how to run the business, right? That is not your role as a shareholder. And so in our small businesses, we do need to be able to identify, what is my role in a capacity as an owner or a shareholder? What is my role in the capacity as a director if I sit in that seat? And if I am involved in day-to-day operations, either as an executive or an officer or even just an employee, what is my role at that level, right? And so as you see here, the board of directors are elected by the owners, right? Some of those directors may in fact be shareholders themselves, but that's not a requirement. And they are tasked with running the corporation to the benefit of the shareholders or the owners. The board, as I said, may delegate day-to-day management, and they often do, to various numbers of officers or executives. And you may find in your own businesses that you are serving in each of these roles. All right, so what are some other features of corporations? If you organize as a corporation, you need to follow certain prescribed corporate norms, all right? These are behaviors that every corporation is expected to follow. They include, but are not limited to, as we mentioned, establishing a board of directors. Those boards need to conduct regular meetings, and they need to keep minutes of those meetings. Additionally, the shareholders of a corporation need to conduct at least one meeting in a year. It's called the annual meeting, at which minutes must be taken as well. At those annual meetings is typically where the board members are elected. So as you can see here, one of those norms is holding periodic elections to seat board members, right? So let's talk about the different kinds of corporations, because if you remember at the beginning of the presentation, we mentioned there were two. You may have heard of S corporations before and C corporations. In general, every corporation is a C corporation out the gate. The minute you register, you are a C corporation until you file an S corporation election. And that S stands for small, right? But don't be fooled into thinking that a small corporation pertains to the dollar value. There are businesses that are worth millions and millions of dollars that are considered small corporations or S corporations. You want to think about that S, not so much in the size of the business or the value of the business, but more so how many owners are involved in the business, right? You can't be a publicly traded Fortune 500 company as an S corporation with millions of different owners, right? S corporations typically are capped at 100 shareholders, right? So that's what they mean by S for small. There's only a few owners of this corporation. right? So to qualify as an S corporation, you have to meet a few requirements. You have to be domestically based here in the US. You cannot be a foreign corporation and then become an S corporation here in the US. You have to be domestic. Only certain shareholders are allowed, right? Individuals, certain types of trusts, estates, but a separate partnership cannot be a shareholder in an S corporation. Other corporations cannot be a shareholder in S corporation, and non-resident aliens cannot be shareholders in S corporations. No more than 100 shareholders, as I mentioned before. Although if there are shareholders that are a husband and a wife, that is considered to be one shareholder for the purpose of this calculation. S corporations also can only issue one class of stock. We'll get back to this again with C corporations where there's more flexibility, but an S corporation can only have one class. And then you can't be an ineligible corporation. And this is going to sound a little wonky, but if you're a certain type of financial institution, bank, or an insurance company, or a domestic international sales corporation, those are examples of corporations that cannot become S corporations. I don't think that is a material issue for us here tonight because we're discussing what sort of business entity you might put together for your cannabis enterprise. And so you wouldn't fall into these sorts of categories. But then again, you know, there are certain benefits that the S corporation can provide that might make it attractive, right? The owners, again, all owners are shielded from personal liability. This is limited liability protection for everybody involved. The judgments, any debts of the corporation, you're gonna have protection from that. And as the shareholders who sit with authority over the board, who is tasked with running the corporation, they have oversight. And if the board doesn't meet their satisfaction, they have the power to elect new directors in a new board. So this sort of answers the different weaknesses that we were discussing earlier in sole proprietorships, general partnerships, and limited partnerships. You have the ability to bring in the investors. Everybody gets to enjoy limited liability protection. C corporations, on the other hand, do not have the same limitations that S corporations have. So for example, they can have any number of shareholders with very few limitations, right? They can create any number of classes of stock or series of stock within those classes. And those classes of stock could have different rights, different privileges. And so that creates much more flexibility in how you go about structuring your business. They have very few limits on how much capital you can raise as a company, and they can be formed domestically or in a foreign jurisdiction. So C corporations do not have the same limitations that you might find with an S corporation. But there is one other very important difference between C corporations and S corporations. C corporations are not what we call pass-through entities. And we'll talk more about pass-through entities here shortly. And that's in regard for tax purposes. C corporations are subject to what we call a double taxation regime. What that means is that the corporation will file an income tax return at the end of each year and pay taxes on its income. This is the first level of taxation. Thereafter, if the corporation paid out any money to shareholders, then those shareholders would have to report those separate dividends on their individual tax returns, as well as pay any taxes that may be due on those dividends. This is the second level of taxation, giving rise to the name double taxation regime. So just want to be real clear about this. You as an individual do not pay taxes twice, but the corporation will pay taxes once on its income. And then if any of that income is left over and paid out to the shareholders as a dividend or a distribution, then that dividend gets taxed at the shareholders' individual level. So nobody gets taxed twice in and of themselves, but the double taxation is a tax at the corporate level and then another tax at the individual level. Right now, you might all be cringing, thinking that that sounds terrible, right? And I think that in a lot of industries, small businesses really gravitate towards a subchapter S corporation for that reason. But hold the phone. If you're thinking that a subchapter S corporation is the way to go, you might be surprised at the end of this presentation. While double taxation may appear undesirable at first glance, it is incredibly important for the cannabis industry. Before we talk more about taxation, let's talk about LLCs or limited liabilities companies for a second, because there is one point that we're going to get to where they are just like S corporations. So bear with me for a second. But limited liability companies are the newest form of business entity that we're going to discuss here tonight. We call them LLCs for short, and they are sort of a hybrid between partnerships and corporations. And they were really created as a direct response to the governance and administrative burdens, those corporate norms we were talking about associated with corporations. Well, at the same time, they didn't want to have all the limitations, quote unquote, associated with partnerships either. They're sort of a middle ground. And so if you take a look at the diagrams on this slide, you can see that there is a number of different ways that you could set up the structure of your LLC. You might be a single member LLC where it's just you, right? And it sounds awfully like a sole proprietorship, but because you went and registered yourself as an LLC with the state, you as an individual or a sole owner are going to have limited liability protection in connection with your business. Now, that would be the first part of the diagram in the lower right. And as you can see from the other two, what does it look like when you bring in other partners? There are a couple of different ways that could be structured. You could be a member managed LLC. And I should point out that instead of shareholders, the owners of an LLC are called members. And instead of holding shares of stock, what they are often issued are what we call membership units. And without getting too wonky about the names, you can just think of an LLC's membership units as being exactly the same as a corporation's shares of stock, right? So with that, you could be a member managed LLC. This is where all the members of the LLC are serving in management. If this sounds a lot like a partnership, the way the single member LLC sounded like a sole proprietorship, you are beginning to catch on, right? So those members in a member managed LLC are running the business the same way the general partners in a general partnership would be running a business. And then finally, sort of the closest structure to a corporation would be a manager managed LLC. This is where a manager or a group of managers is inserted by the members and tasked with running the business. Now, those managers may run the business themselves, or like a board of directors with a corporation, they may delegate that day-to-day operations role to executives or officers of the LLC, in which case those managers or that manager would be serving in the exact same capacity that a corporation's board of directors would serve. They're charged with running the business. They've delegated that responsibility to officers and executives, and now they are conducting oversight and governance on behalf of the members, right? Like shareholders in a corporation, as I mentioned, all LLC members benefit from limited liability protection. However, and this is important to point out, an important difference from corporations, when it comes to management, governance, administration, LLCs are much more flexible than corporations. Right? You have the option, as I mentioned, to structure yourself as member managed or as manager managed, right? And those managers could be members, or they could be third parties that you appoint and hire. It could be an outside service. It could be bringing in individuals, and their responsibilities and the way management will be conducted is largely up to negotiation through what we call an operating agreement, right? LLCs do not have to observe many of the corporate norms that corporations must observe. The way they handle their business, again, is dictated by their operating agreement, which is a negotiated document amongst the members. I should also point out, and this is getting back to their similarity with S corporations, LLCs are treated as pass-through entities for tax purposes by default. So we talked about double taxation before. Let's talk about what it means to be a pass-through entity. An LLC, similar to an S corporation, will generally file an informational return, but not make any tax payments itself. Rather, they file a statement on behalf of each of its members, and that statement will say the proportion of gains or losses that the LLC is attributing to that member. If it's gains, the LLC member may have to pay tax on those gains. So this is important. The LLC pays no taxes itself by default. It's all going to be paid by the members based on the members' proportionate share in the gains and losses of the LLC. So the reason why we do not recommend S corporations and we do not recommend default LLCs for this industry is because of that pass-through taxation that I just described. We talked about limited liability and how it would protect you against creditors, how it protects you against the debts of the business or claims brought against the business. There is one very, very important exception to that in the cannabis industry, and that is taxes. Because they are pass-through entities, meaning tax liability passes through to the owners, the limited liability protection does not extend to tax deficiencies. If you're a pass-through, if you're an S corporation or you're an LLC, by default, not making an election, right? And the company can't afford to pay the tax bill, they can come after you as the owners to answer for that tax bill, right? This is why, even though a C corporation is subject to double taxation, it is an ideal form for this industry. Remember, we're in cannabis. Every one of these businesses is at very high risk for audit because of Internal Revenue Code 280E. They're at very high risk to have their deductions disallowed. And a consequence of that is that it is very easy to be found deficient in your payment and taxes. And if the business can't afford to pay, they're going to come after you personally. So again, the beauty of double taxation here is that the corporation, a C corporation for that matter, is going to pay its own taxes. That tax obligation does not flow through to the owners. So the C corporation pays its taxes. If the C corporation doesn't have enough money because it was found that the tax they paid was deficient, guess what? You can fold up the C corporation and the owners can walk away. Their limited liability protection is intact because the tax obligation did not pass through. Now, you may be asking yourself, why do I see limited liability company up there with C Corp if he just told me it was a pass-through? Again, this is the beauty of LLCs and the flexibility that they have. As an LLC, you can make an election with the IRS to be treated as a C corporation just for tax purposes. Let me reemphasize that. Just for tax purposes, you can elect in your LLC to be treated as a C Corp. That does make the LLC subject to double taxation, just like a C Corp. But because of the inherent risk of tax liability, we recommend that businesses in this industry accept that double taxation obligation, if for no other reason, to protect their owners from any potential tax deficiency judgment that may fall to the business. These are the only entity structures that we presently recommend to form your for-profit cannabis business, right? Just to recap that, both of these structures afford their ownership limited liability protection, the entirety of the ownership. It's not like a limited partnership where the general partner is still at risk and everyone else is protected. Everybody is protected in this scenario, right? This limited liability protection that I mentioned does not extend to tax liability for pass-through entities, right? Just as a reminder, cannabis is still federally illegal. 280E applies, as I mentioned, but with the C Corp and with the LLC making that corporate tax election, these are the only entities that provide comprehensive limited liability protection and are advisable for the commercial cannabis industry. So with that, I've concluded the presentation and I'll be happy to answer some questions.
Thank you so much. That was a wealth of knowledge. It was alphabet soup. We had S Corp, C Corp, LLC, ABC. I heard Jackson 5 singing in the background. That was a lot of great information. As a small business owner myself, very informative and right on point. There's a lot of things to be really looking at, and I really appreciate that information. And I know everyone listening and everyone that will be watching the videos in the weeks and months to come will be very well served by the information that you provided. So I'm going to go to some questions. We always have fun with these. Let's start off by asking, I've heard of this concept of the corporate veil. What does it mean, Zachary, to pierce the corporate veil?
That's a very good question. So we spent quite a bit of time talking about limited liability protection tonight, where if there's a judgment that's brought against the company, or if there's a debt that the company owes and the company can't pay, if you have limited liability protection, then generally you are not going to be held responsible for those debts or those judgments. But that protection is not absolute, right? Under the right circumstances, a claimant against your business can bypass that limited liability protection and go after you individually. And that is what we call piercing the corporate veil, where they can bypass that limited liability protection. It only happens in the most rarest of circumstances. And some of those are being if you are commingling your personal assets with the assets of the business, if you are executing agreements in your personal name instead of in the name of the business, that's another misstep. And then the most common is if you're actually engaged in fraudulent behavior. So if you're defrauding people, the limited liability protection won't shield you and they can bypass it. So it's very rare circumstances. They generally will not allow anyone to pierce your corporate veil because you made mistakes or bad business judgment. That's not the measure here. It's really extraordinary circumstances where that corporate veil could be pierced.
Yeah. Well, thanks for that. Next question. We talked about corporations. You mentioned corporations. How many directors must a corporation have?
That's a great question because it varies depending on what state you're registering in. I know that some folks in this industry will register their business out of state and then get foreign qualification here in California. Here in California, if you register a corporation, you only have to have one director. That's the minimum. You do have to name certain roles with your corporation here in California. You have to identify a president, you have to identify a treasurer, you have to identify a secretary of the board. But it can all be one person wearing all three of those hats, or it could be multiple people. But the minimum is one here in California.
All right. Okay, this is an in-depth one. What are other governing documents that are required or advisable, or what are the governing documents that are required or advisable when you're forming a corporation or LLC?
Yeah, so when you register these businesses, you're going to be preparing articles, right? That's what actually gets filed with the state. For a corporation, it would be articles of incorporation. For an LLC, they're called articles of organization. These are literally the paperwork forms that get sent into the state and filed to kick off the registration process. But beyond that, these entities need to provide for their own governance. The same way in a partnership, you might have a partnership agreement. And an LLC, you would have an operating agreement. And for an LLC, that is the end all be all, right? That's the one absolute agreement that sort of covers everything for an LLC at a very high level, the operating agreement. Corporations are a little bit different, going back to the corporate norms that we discussed and how they're expected to follow certain practices. That also tracks into the documentation required. So every corporation must have a set of bylaws. Those bylaws are what lay the ground rules for how the corporation is going to be governed. And then I think it's not required, but it is highly advisable that every corporation establish some sort of shareholder agreement. And that shareholder agreement is what specifies or spells out the relationship that the shareholders have to each other and the relationship that they have to the company, right? And so I think those are they're probably the two critical documents for any corporation that's being formed.
Right. Well, that's really good information. My company is an LLC, and I started off as a sole proprietorship for a very short period of time, and then converted over to an LLC. And all this is bringing back a lot of good memories, if you will, making sure that we structured the right way, and ran things appropriately, given that we're growing as a business.
Well,
Let me ask you this. I'm sorry. Go ahead, Zach.
well, I'm sorry to interrupt, but Ernesto, I think you said something there that just made a very good point. You started off as a sole proprietorship, and then later you reorganized as an LLC, and that just prompted me to say that none of these are set in stone. Okay,
Right.
if you organize one way, you can always reorganize. If something wasn't set up right, it can be redone. The advantage of thinking this through in advance is that you can try to knock it out the first time and save yourself some expense and a headache. But for those of you that are operating right now or have already registered on your own, and it's not quite what we were recommending, and you want to change, it is not too late to change. You can change it.
Yeah, no, that's a great point. And if I had to do it all over again, I would have started off as an LLC. There was costs involved, and I was operating out of my home like a lot of people do, and I wasn't as informed, quite frankly. And looking back, I would have definitely myself started off, and that's what have made sense for me as an LLC, and thus converting into an LLC. But I agree with you. I think obviously making those right decisions based on what your company is, or where it's at, where it's going to be. I think that's super important. Let me ask you this: having said all that, what are are there disadvantages to incorporating or forming an LLC? I mean, obviously this is something that we're focusing on, but are there disadvantages?
Yeah, and we have to be honest about that, right? Look, people get into sole proprietorships because it's the easiest thing to do, right? They just
Exactly.
go out there and hang their hat, hang their shingle. Partnerships the same way. If you and your buddy want to start getting into business, you can just do it, and it's not complicated. LLCs and corporations, it's a bit of a process, right? You have to form these things. There's a registration process. There's documents that need to be put together. You should probably be getting legal advice. That's going to cost something. So there are additional expenses and administrative costs to putting together corporations and LLCs and then running them. Particularly with corporations, there are compliance obligations that you have to meet with corporate norms. Don't let that scare you. You're getting into the cannabis industry, or at least you thought you were. What you're really getting into is the compliance industry. So, get used to the idea that you're going to have to do a
Right.
fair amount of compliance work. But, again, that's one of the things that, is germane to corporations and LLCs that you wouldn't have to do otherwise. And then, the 800-pound gorilla in the room that we talked about tonight was the double taxation. If you go with one of our recommended entities, a C Corp or an LLC making a C Corp tax election, you are going to go through double taxation, right? And yes, that will ultimately reduce your take home and your capacity as an owner. But I think the upside and the protection is well worth that.
Yeah. No, and I think this really touches on a great point. Having a good team around you, having good advisors. And what, at the end of the day, quite frankly, this is what DCR is all about, right? Providing the resources, providing the information, and really, formative and foundational items such as this is so crucial to making those right decisions from the get-go, and being able to change if need be. And it's really great that DCR is providing this information and giving those resources to everyone that's interested and thinking along those lines. So it's great. It's perfect, Zachary. So I'm gonna end with this, Zachary. I'm gonna ask you this question, and I like to throw this out every once in a while. If you had to impart 3 key pieces of wisdom on anybody or everyone that's listening, or anyone that would potentially listen in this area of focus, what would be those top 3 things?
So with regard to this topic, I think my 3 recommendations would be: 1, as I said, the recommendation at the end, a C Corp or an LLC making an election is the only way to really go. I think number 2, make sure that you get help and guidance with this process. Don't run out to LegalZoom or some document preparer and think that you're going to be able to do this on your own. They might get you as far as getting your business registered with the Secretary of State, but I want everybody to be aware that you're going to have to go out and likely raise capital. You're going to have to negotiate with investors. You're going to have to bring money in. You're going to have to team build. And if you just ran off some templates off of Google and presented those, chances are they're not going to meet your needs. Chances are your partners are going to try to steamroll you in terms of what they want to see in those documents. It is really important that you get some help with this. And then, be proactive about this process, I think would be my last recommendation. Get to this early. Don't wait until, deadlines are approaching and you have to get applications in and you're trying to work out deals with partners to think about this piece of it. Think about this piece early. Think about the needs of your business and the direction you want to see it going. And let's try to put a structure in place that would accommodate that. So that would be my 3 pieces of advice.
I like that. I like that you ended with think early and often, right? Think early and often about this, because it is an ongoing situation from the get-go. So no, you know what, Zachary, you're always a wealth of knowledge. Always thrilled to be working with you and presenting these webinars. I just want to say a big thank you on behalf of the collective team and DCR and everyone listening. I want to say thank you. I want to say thank you to everyone that has attended or is attending this very informational webinar offered by the City of Los Angeles Department of Cannabis Regulation. This webinar, the recording of it will be found on DCR's Learning Management System within a few weeks of this presentation. If you have any specific questions on accessing your account, please email dcr.scp@lacity.org. Thank you again all for joining us, and have a wonderful evening, and go Lakers.